Most people believe that the price of silver is determined by a transparent global market of supply and demand. You assume the ticker symbol on your screen represents the actual value of metals stored in high-security vaults in New York or London. But the reality of the precious metals market works very differently than most people think. The gold and silver you think exists in the Western financial system is, in many cases, little more than a digital promise. And the real mechanism behind the draining of Western vaults is rarely explained by the institutions managing them. Inside the global arbitrage market, a massive vacuum is pulling physical metal toward the east, leaving the West with nothing but paper. Once you understand how this systemic drainage is being orchestrated, the idea of Western market stability starts to look very different. This analysis examines the structural breakdown of the COMEX and the COMEX and the institutional shift of physical wealth from west to east. We are witnessing a systemic divergence where paper prices in New York are losing their connection to the physical reality of the Shanghai Gold Exchange. This is not a temporary market fluctuation. It is a fundamental realignment of global monetary power. Most will only recognize it after the vaults have been completely emptied. While the world remains fixated on Federal Reserve interest rate decisions, a silent and massive movement of wealth is occurring in the shadows. Currently, the price of silver in China is consistently trading at a premium of 10, 15, or even 20% higher than the price in New York. This is not an error or a glitch in the system. It is a structural arbitrage that acts as a powerful suction, pulling physical metal out of Western warehouses and into Chinese industrial and sovereign reserves. The COMEX, once the titan of global price discovery, is being stripped of its physical backing by a market that values reality over digital contracts. For decades, the Western financial system has functioned on the illusion of abundance. The COMEX operates primarily as a paper market, where hundreds of ounces of digital silver are traded for every single ounce of physical metal. This works perfectly as long as no one asks for delivery, but the mechanism is fragile. It relies on the assumption that investors will always be satisfied with a cash settlement, rather than demanding the bars they supposedly own. This illusion is now being challenged by a global player that has no interest in Western paper promises. In Shanghai, the market is not built on digital leverage, but on physical settlement. When a buyer in China enters the market, they are looking for industrial inputs or sovereign wealth. They are looking for metal they can hold, melt, and manufacture. This demand has created a persistent price gap. If you are a large institutional bank and you can buy silver in New York for $28 and sell it instantly, in Shanghai for $32, you will move every ounce you can find across the ocean. This is the Great Arbitrage. And it is leaving the COMEX registered inventories at levels that are historically and alarmingly low. The systemic misunderstanding lies in the definition of registered versus eligible silver. Most people look at the total vault numbers and feel a sense of security. But the reality is that only the registered category is available to back massive short positions and delivery demands of the market. As this category continues to shrink, the institutional asymmetry becomes undeniable. The West is selling its physical legacy to maintain a suppressed paper price, while the East is accumulating the only assets that will matter when the paper system eventually seizes up. China's hunger for silver is not merely speculative. It is deeply industrial. The global transition towards solar energy and advanced semiconductors requires massive amounts of physical silver, metal that cannot be substituted by a digital contract or a line of code. Chinese industry is effectively outbidding Western investors for the world's remaining supply. They understand that in a world of decaying currencies and expanding debt, physical supply controls the future of technology and trade. Because most people only discover the reality of physical scarcity after the market has already moved into a state of permanent exclusion. The danger of this mechanism is that it appears gradual until it becomes total. We are approaching a threshold where physical inventory in New York will no longer be sufficient to cover outstanding paper contracts. When that day arrives, the market will face what is known as force majeure. This is a legal clause that allows the exchange to settle contracts in cash rather than delivering the metal. In that moment, the price of the paper silver could drop to zero, as the contract is revealed to be worthless. While the price of the physical metal in your hand would effectively disappear into the stratosphere, most people believe they are invested in silver because they own an ETF or a mining stock. But they fail to realize that these are just more layers of the paper system. They are derivatives of a derivative. all resting on a foundation of physical metal that is currently being shipped to Shanghai. This is the late realization that characterizes every systemic collapse. The discovery that what you thought was an asset was actually someone else's liability. The institutional power that manages the COMEX is aware of this drainage, yet the mechanism remains hidden from the general public. To prevent a chaotic rush for the exits, the structural loss of control is already visible in the data. We see banks moving record amounts of metal between continents, not to serve clients, but to capitalize on the price gap. This institutional movement is a signal of the endgame for the dollar-denominated silver price. When the COMEX is finally drained to near zero, the West will lose its ability to set the global price of commodities. The power of price discovery will move to the markets that actually hold the physical goods. At that point, the cost of acquiring silver for the average individual in the West will become prohibitive, assuming there is any left to buy at all. This is not a market prediction. Most people assume that if the price goes up, more silver will magically appear. But mines take a decade to bring online, and industrial demand is inelastic. You cannot build a solar panel with a paper contract. You need the atoms. And those atoms are currently moving east at an accelerating pace. The illusion of ownership persists only as long as the delivery window remains open. Once the COMEX declares it can no longer fulfill physical delivery, the gate will close. The gap between those who hold physical metal and those who hold digital promises will become an unbridgeable chasm. True awareness in this environment requires recognizing that the current Western prices are artificial. By the time the Western ticker symbols catch up to the Shanghai reality, the opportunity to position oneself will have vanished. The system is designed to reward those who see the structural flaws early and penalize those who wait for a formal announcement. The central banks and large industrial players are already positioned. They are the ones initiating the arbitrage because they understand that the paper system is a temporary construct, and secure assets that exist outside the reach of an exchange's force majeure clause. But the mechanism for that collapse was built over years of quiet depletion. The question is not whether the COMEX will run out of silver, but what the world looks like once the East has finished draining the West. The shift of physical wealth is the ultimate precursor to a shift in monetary authority. Those who understand the mechanism of the Shanghai premium see the writing on the wall. They know that in a battle between a digital promise and a physical bar, the bar wins every time. Have you ever tried to take physical delivery of an asset only to be met with delays, high premiums, or unexpected administrative